because stocks are continuing to look shaky from trade concerns. Of course, we know that President Trump wants to raise tariffs on Chinese goods from 10% to 25%. And really, all of this has truly become, for the moment, a battle over tech and IP. The Consumer Technology Association says that this move would amount to a 25% tax on American consumers, since companies would pass on the cost of tariffs to consumers. And joining us live from D.C. to discuss more is Sage Chandler. She is VP of International Trade at the CTA. Sage, thanks for joining us. Let's start this way. I know you guys work with tech companies, big and small, and many of them, from what we hear, are already adjusting their supply chains, trying to move away from China. Tell us what you're seeing and hearing as a result of all the tariff tensions.
Hey, thank you. It's been really difficult, and let me just correct you on one thing you said in the intro. You said that the president wants to move from 10 to 25% tariffs. It's already at 25%. It's at 25% for thousands upon thousands of products. And this final round of tariffs that he's talking about on $300 billion worth is going to put basically the rest of trade with China at a 25% tariff. So that's pretty much everything that consumers go out and buy. So much of it is either from China or parts are sourced from China. And so for our companies, 80% of them are small businesses. We have all the big members that everybody knows and their everyday brands and their gadgets. But the majority of our companies are small and medium-sized companies, and they're the ones that are feeling the impact fastest and hardest, and are the ones that are really struggling to adjust. And sort of a misnomer is that Chinese stuff is cheap. It's not actually always the case. China has a very sophisticated supply chain, and it's just a piece of the way companies do business. We find that oftentimes our companies do the research, the design, the engineering, the intellectual property heavy stuff is from the United States. And if they need to source a part or pieces from China to keep that those higher paying jobs in the United States, it's a piece of the chain that actually works and enables our companies to be innovative and move quickly and respond to consumer demands. And so upending it, and oftentimes lately it's been with little more than a month's notice, is incredibly disruptive for business models.
Sage, I want to jump in here because, so much of the discussion around U.S.-China trade has been in the context of, once a deal gets done, well, then the temperatures will cool a bit and things will get back to normal. The reality is a lot of these companies I know have already been shifting up their operations. Can you talk a little bit more about what you have seen?
Sure. They're trying to shift, and it's no one model. We can't talk about any specific model for companies overall, because they all are operating differently and how they have to. We've seen companies that are just sourcing product that are able to go elsewhere and source the product from elsewhere. And oftentimes, most of the times, that's not from the United States. We see companies who built factories from the ground up there and have employees here and have employees there, who are having to make the difficult decision of whether they leave their bricks and mortar and all of the trained employees behind and go somewhere else or outsource that business. We're seeing that. We're seeing companies who are on the U.S. side of things and are trying to figure out how to deal with price increases, because they have to pass the cost all the way down to consumers, but consumers won't pay more. So it's multiple facets of this, and a lot of different ways companies are trying to deal with it. We see some companies that have managed. We're seeing some companies that are still trying to figure out if they're going to be able to survive.
I was surprised to see that tech industry is paying $1 billion every single month because of this trade war. What do you expect that's going to be moving forward if President Trump decides to have tariffs on virtually all Chinese goods?
Yeah, so that's that $1 billion per month, and I should clarify, that's not the sort of tech industry overall. That's products identified from our member companies. So just CTA member companies went out and looked at the universe of products that are already under tariff. And just our companies and just the product lines that they identified is at $1 billion or over $1 billion a month now, more than they were that same month a year prior. The last list was $200 billion worth of tariffs on Chinese product. This new list, list 4, is $300 billion, and that's the rest of trade with China. So I could conceivably imagine that the cost would go up, double what we're seeing now. And those products that haven't yet been tariffed but are on this new list are things that are consumer facing, things like smartphones and laptops and tablets and video games consoles and just the things that people go out and buy at their big box retailers or their small mom and pop shops in the corner of New York City. These are the things that are going to have an extra 25% tagged onto them. And it's not always that easy, because if you're selling something like a home entertainment system, well, maybe 3 pieces of that had a 25% tariff. So that's a 75% increase. And how do you deal with those increases, and will the consumer pay them? And we're seeing that that's not going to be easy to pass that down.
Sage, I know we've talked in the past about the impact this is having on CapEx, the investments, companies are holding back on because they have to pay the tariffs. They don't want to pass the cost down to consumers just yet. Can you talk a bit more about the long-term impact of something like that? Because as they hold back the money, we're not seeing the investments being put in R&D.
Right. Well, I mean, it's hard to, when you look at forecasting on the economy, generally price impacts and hiring decisions, you start to see that those things shake out maybe 3-4 months down the line. But this is going to be pretty skewed, because the behavior that we're seeing from our companies is a lot like hoarding behavior. So companies hear that there might be a 25% increase on their inputs, and they have to do their best guessing at what their own sales forecast looks like. So they go out and they try to purchase as much as they can early, but what that does is it takes their cash reserves and their financial ability out of other areas like R&D and investment and being able to hire. So you're skewing the market right off the bat. And then if you play that out further, we're not just talking about tariffs on the American companies and American consumers. We're talking about our own business's ability to export, because, of course, China has retaliated. And so all of that sort of American ingenuity and the things that people outside the United States want, and China is a huge and growing market, now they have a limited ability to sell as well. And all of that is going to play into sort of longer-term ability to grow not only our industry but the entire economy. And I fear that things could get pretty bad.
All right, we will keep watching and check in with you again soon. Sage Chandler of CTA, thanks so much.
Thanks for having me.